Hello everyone and welcome to this Finance for the Future event. Finance for the Future is brought to you by ICAW, A4S and Deloitte. I'm Philippa Kelly, Head of Financial Services and Director of ICAW's Technical Strategy Business Group. I'm really delighted to be hosting this panel discussion on moving financial markets, how to accelerate financial markets to drive a green and fair economy. I'm joined by four fantastic panelists for today's session. Sarah Breeden, Executive Director for UK Deposit Takers Supervision at the Bank of England. Pavan Sukhdev, President of WWF International. Michael Marshall, Head of Sustainable Ownership at Railpen. And Alison Vipond, Sustainability Policy and Innovation Lead at Ecology Building Society and winner of the Building Sustainable Financial Products category at the 2019 Finance for the Future Awards. So I'm sure that we're going to have a wide-ranging and very interesting discussion here today. I think the context of this year and the increasing impetus around sustainability and climate change in particular in financial services means this comes at a very important point when everyone will be looking to next year and recovery from the pandemic and the role that we all have to play in driving that forward. And before we start the discussion, we'd like to ask you a poll question, which will appear on your screen momentarily. So if you could just select an answer on your screen, how confident are you that the finance sector will show leadership by driving a more sustainable economy? Very confident, confident, neither confident nor unconfident, not confident at all, or don't know. So just give you a moment to think about your answer there. And then we should hopefully be able to see what people are thinking. Okay, so that is really good to see. So the majority of people are confident or very confident, but we do have a proportion who perhaps aren't quite sure. And I imagine the uncertainty of this year and what we're expecting from next year perhaps has a part to play in that, as well as the proliferation of initiatives in this area and perhaps knowing where to start, what to prioritize and how to proceed. So we'll kick off today's discussion, and I just want to mention, based on the success of Our Planet, Our Business and the Our Planet series, WWF have created a new film for business. This is one that's specifically aimed at the finance sector, Our Planet, Too Big to Fail. And it shows the impact of what they refer to as investing as usual on the planet, including a series of thought-provoking interviews with some of the most influential names in the sector to show the role that the sector can play in the transition to a sustainable future. Pavan, can you tell us a little bit about what that vision for the finance sector looks like and actually how far we might be in achieving that at the current time?
Yes, and I think the need for the finance sector is fairly clear. We need to recognize our significant role in determining the direction of the economy. Finance is the blood that makes in the veins of the economy. We need to ensure that we recognize risks appropriately. We put in place systems to manage those risks. We ensure that we do not misdirect finance, public finance especially. And we ensure that we have the means of promoting elements of the green economy, which are, if you like, budding at present, but they're not necessarily getting the ability to support and the support that they need. So there's quite a number of things that we have to do in that. But I'll just focus on three, which I think, to me, strike me as being particularly important. Firstly, this whole issue of measuring and recognizing risk. And let me begin by saying that today's externalities in a corporation are actually a big part of the problem, because today's externalities are tomorrow's risks and day after tomorrow's costs. And one of the main aspects of business as usual, which clearly can't continue, is this whole idea that we ignore externalities. They're just too big. They're trillions of dollars. And we're talking about 4 to 11% of the economy, depending on whose estimates you use. These externalities seep through. Today's externalities being tomorrow's risks and day after tomorrow's losses seep through into investor portfolios. Basically, they are the hidden alpha, or if you like, the hidden negative alpha in those portfolios. They seep through in the balance sheets of banks. They are the risks that our VA value at risk system simply do not catch. We catch all kinds of other things, credit, market risk, and so on, but not these. So I think step one is to figure out what to do. And I'm very glad that the Institute and the Bank of England are both involved in their own ways. And also glad that they are in touch with groups like the Capitals Coalition, which I'm proud to represent here, the Impact Management Project, the Value Balancing Alliance, the Institute itself, and the European Union is also deeply committed to these changes. So that's it's moving in that direction. Another thing that we need to recognize is that if we have unmanaged risk, that's partly because we seem to have lost the ability to track and measure and manage leverage. What do I mean by that? I was a banker for 24 years in my life. And when I was a young banker, I was hammered home the message that we must always establish purpose in assessing lending proposals and proposals for lines and limits and so on. But the idea that purpose is at the heart of finance seems to have been lost, because today you can go to money markets, fixed income markets, you can reach off across the border and achieve financing of many different tenors and currencies and varieties and so on, and supported by derivative structuring. So you can access finance a lot more easily today, thanks to deregulation of capital markets and the fact that cross-border flows are permitted, as against 40 years ago when I was starting out in banking. But the underlying issue that you need to establish purpose in order to recognize whether it's an appropriate or not inappropriate financing has a cost if we simply ignore it. And that lack of control on leverage is actually, if you think about it, the reason why we had the savings and loans crisis in the US, the Latin American debt crisis way back in the late 70s, the Asian debt crisis in the 1990s, the global financial crisis in 2008, and we seem to be, again, forgetting that you cannot simply reflate economies, add huge amounts of liquidity, not have the means of controlling that surplus liquidity, pulling it back at some point. And also that you cannot simply not have any control on the purpose of financing. Thankfully, there's one little strain positive, a nice note that comes out in terms of green bonds, which is that they are reintroducing purpose into financing. To me, the fact that they're green, they're for a green purpose, is the fact that they're for a purpose in the first place. That gives me hope that, this whole discipline of getting purpose back into financing will hopefully get back as a message. And my last point, which I'll make, which is to do with the nature of public finance. Typically, in banking, one tends to think in terms of a 1:5 or 1:10 ratio between public finance for an area versus the size of private finance that flows into that area. Today, a lot of the green economy, whether it's renewable energy or whether it's sustainable agriculture, just doesn't get that focused investment. And of course, the classical, if you like, conservative reminder that, but the Obama administration invested in Solyndra and it dropped $500 million. Yes, but you tend to forget that the Obama administration way back also at the same time invested in a company now known as Tesla, which is now worth $600 billion, which is 10 times the size of General Motors, the next largest car company, and 15 times the size of Ford, right? So one tends to forget that appropriately selected across portfolios, public finance does sometimes make a big difference in engendering the green economy. A green economy will come as a result of these and many other factors, which I'm sure we'll hear about in the comments of our panelists. But I think recognizing risk, understanding that today's externalities are tomorrow's risk, putting in place the mechanisms that you need to measure and control those, understanding that limits to leverage are not luxury but a necessity, and that's part of a discipline in finance, and understanding that the direction of the economy is in part determined by the direction of public financing. I think these are some background issues that we really must address in our effort to green the global economy.
Thank you, Pavan. And just before I move to Sarah, I should quickly add, I'm so keen to get to this discussion. I forgot to say that there will be time for Q&A at the end. So if you do have questions, do use the box on your screen to enter those, and then they'll make our way to us. And just reflecting on Pavan's comments about purpose and internalising some of those externalities, it seems that one aspect to that, Sarah, will be behavioural change. What do you see as the role of the regulator in driving that?
It's a great question to ask, Philippa. Why does the Bank of England, as a financial regulator, care about climate change as a financial risk and not other sources of risk and externalities with the same fervour? And that's because our view is that the risks that climate change brings have got distinctive characteristics that require a different approach if we are to manage them well. Let me explain. First, these risks are far-reaching in their breadth and in their magnitude. They're going to affect every corporate, every sector, every geography. The impact is going to be correlated, non-linear, irreversible. And all of that means that the financial risks from climate change are going to occur on a much greater scale than other risks. Second, these risks are simultaneously uncertain and yet totally foreseeable. So I can't tell you now exactly what combination of physical and transition risks we are going to see, but I can say with complete certainty that either we carry on our current emissions pathway and we face physical risks, or we change our pathway and we face transition risks. And that creates the obvious issue that uncertainty about what will happen will lead to inaction and inertia. And that brings me to my third point, which for me as a financial regulator is the key one, which is that the size and balance of our future risks are going to be determined by the actions that we take now. And that's because if we wait until it's clear that we want to reduce the physical risk from climate change, the science says it's too late to do so. And similarly, the longer that we leave meaningful adjustment to start, the more disruptive a transition we're going to see. And so those three combinations of factors gives us a particular focus to ensure that the financial system is doing the best job it can of managing this far-reaching, uncertain yet totally foreseeable risk that requires action today. How are we trying to do that? First, we need to green finance by transforming reporting and risk management so that every financial decision takes the risks from climate change into account. That's where the regulators are seeking to lead. But then second, we need to finance green through innovation and investment choices, and so drive change in the real economy and support an orderly transition to net zero. And I'm sure that's a theme that others on the panel will pick up. But let me just dig down into what greening finance means. As I said, we need to get two things right, reporting and risk management. We've got a go-to framework for companies to report on their climate-related financial risks in the TCFD, the Financial Stability Board's task force on climate-related financial disclosures. It's got huge support, which is great, but we need to see an improvement in the quantity and quality of disclosures because climate change is a risk we see looking forwards, not backwards. Depending on what you disclose, you can assume it away. And we need to move from the static to the strategic using scenario analysis to help us better size future risks. The UK government has just announced that we're going to make TCFD disclosures mandatory in the UK over the next 5 years, a vitally important step and will help us all better manage this risk. But in addition to better reporting, and this goes to Pavel's comments, we need to transform risk management at the level of the firm and importantly also at the level of the system. On the former, we've said that the banks and insurers we supervise need to embed our expectations for management of climate-related risk by end 2021. That's all about governance, risk management, scenario analysis, and disclosure. And they're designed to ensure, as you said, Philippa, that firms change their behavior. They take a strategic and forward-looking view to managing these risks that are embedded in business as usual risk management, but grounded in the long-term financial interests of the firm. But in addition to doing that firm level risk management, we need to consider system-wide risks as well. We've recently announced that we're undertaking a climate stress test exercise. It's going to be launched in mid-2021, though we and the firms who are doing it are doing a lot of work now to get ready for that. And that exercise is going to do three things, which I think will be really important. First, use scenario analysis to shine a light on currently opaque risks. Second, to highlight where financial firms and their customers' business models need to change. And third, to build risk management capabilities and prompt engagement on climate risks. And I think if we do that, we'll have a really solid basis on which to build the financial risk from climate change into every decision that banks and insurers make. And then what we need to do is finance green, to have the financial system steward the economy on an orderly path to net zero through investment and through innovation. And I'm sure others are going to pick that up. Philippa, back to you.
Thank you, Sarah. That was really nice to just hear the multifaceted approach and just the extent of the challenge that we are still facing, even though it feels like there is so much activity going on. We're still very much in the early stages in many ways, and was interested in your comments about we need to do this now, and there's almost a parallel with how we handle the pandemic, in the sense that the messaging has always been, if it feels premature to be taking these actions, then it's hopefully the right time, because if you wait till it feels right, then it will be too late. So no, thank you very much for that. Michael, it feels like a challenge around investors driving the sustainability agenda. How do you make green the new normal for pensions?
Thanks. Well, I think before I answer that in some detail, I should say that I think we're already at least part on the way. Investors have stepped up in certain areas, I'd say, in terms of stewardship and some collaboration initiatives such as Climate Action 100, and getting certain high impact businesses, at least in listed markets, to amend their business models that look something like the Paris Agreement. That is progress compared to where we were 5 years ago, 10 years ago. So I think that investors are getting there, and I was pleased with the poll result. I would have answered B as well. So hopefully it's not just a personal view. I agree with Sarah's comments that a lot of this is about risk management and reporting. We were part of the consultation response on TCFD reporting, and we already do report on TCFD, but it's so important that all actors are providing some level of comparative disclosure. It's important for themselves, but it's also important for a regulator to look at those, to look at the system level and look at system level risks. I think that how do we make green the new normal for investors? I break it down into three things. There are many ways to analyze this problem, but I would break it down into three. One is to make sure there's an appreciation of duties, and fiduciary duty is usually couched or interpreted in a stock specific or idiosyncratic way. It's normally interpreted in the way that if you're investing in an asset, a security, or if you have a portfolio that itself faces risks which are financially material or could be financially material on a reasonable time frame, then those risks should be managed. And that captures most of what a long-term investor like a pension fund would care about. But in my there are duties to look at systemic risks, not just idiosyncratic risks. Coming back to Pavan's point about externalities which could internalize into a risk, some of those systemic risks that long-term investors should care about, they might not internalize on a time frame that makes sense to us. So the time frame that makes sense to us on a climate perspective is this decade, 2020 to 2030. And we need to care about the risks, yes, that internalize in the short term, but also ones that are relevant to us from a systemic perspective, but might not be priced in for a company or priced in for an equity investor or a debt investor. There is a broader, more universal ownership perspective to duties. So I think the first thing that investors need to do is appreciate duties, and that there's a dualism to that: risk management, but broader level systemic risks. I think the second thing is information. We need better quality information, this is a well-trodden path. People have complained about data and proper information for a long period of time, but investors, like asset owners, I speak from an asset owner perspective, we need to know where are the hotspots in our portfolios. We need complete data, not just on listed equities. We need it for private markets and for infrastructure. We need to make sure that we have things that are comparative, but that don't lose the specific nature of certain types of investments, such as illiquid investments versus liquid investments, or certain investments in certain sectors versus other sectors. So we need some comparative information, but we need some relevant and specific information too. We need, crucially, to work out whether a particular portfolio or a particular asset is aligned with Paris or not. And that is probably the key informational challenge for investors right now. There are some tools out there, but not enough. I think that the third thing I would say is we need to collaborate. And I'd say that we're quite good at collaboration, but we need to do a lot more. Investors collaborate with others, particularly large investors, particularly European investors for that matter. But we need to collaborate with other parts of the economy, other parts of the network that really matter. So investors can't solve all this by themselves. There are at least 4 stakeholders that need to do something: policymakers, investors, corporations, and consumers. And all of those stakeholders need to improve. And some of that can be done in an instrumental way by putting a price on carbon, or by changing subsidy arrangements, taxing, emissions trading systems, things like that, or indeed by product bans and so on. But I'm not sure that all of it can. So we need to collaborate and talk to one another. I'll just make one last point before handing it back, which is on information. I think we also need to make sure there aren't too many competing information streams. People that are familiar with sustainability or ESG will be well aware of the alphabet soup of initiatives that proliferate year to year. And one framework that we use and have found useful is the SASB framework, the Sustainability Accounting Standards Board, which has recently merged with the International Integrated Reporting Council. And that kind of activity we find very useful. 2 very similarly minded organizations with broadly the same purpose coming together and saying, you know what, we can work together on this. Now, they cover some of the information set, but not all of it. But it's great to see some streamlining in that arena. So my answer would be appreciation of duties, decent information, and collaboration.
Thank you, Michael. And then I agree, it's very positive to see that streamlining, and hopefully that makes aspects of this more accessible for perhaps the firms who aren't as engaged as they could be yet. And Alison, moving to you, I suppose Ecology is extremely engaged in this space and has been for a long time. So I would ask, how can we get green products to scale up to accelerate change to drive a green and fair economy?
Thanks, Philippa. What I've heard so far from the panel actually is music to my ears, talking about purpose, for example, and greening finance to finance green, because that's at the heart of what Ecology, little old Ecology as we call it, a small building society in Yorkshire, but trying to do great things. That's what we've been doing for 40 years. So we have a mission that really drives everything we do, to enable environmental protection and sustainable communities through provision of mortgages at the end of the day for sustainable buildings and communities. So hearing that purpose is so important is great, and I think we need to continue to do that. I'd also just like to pick up on the point about collaboration that Michael made, because I think that is so critical, and that's ultimately how we're going to scale this up. We all have to be part of the system, and this is going to take a massive team effort. The kind of transformation that we require is going to be like nothing we've seen before. It's going to require financial transformation, social transformation, technological, everything. So I think we have to see ourselves as part of that system and take a leadership role in it. But within that team, if you like, we need political leadership, and I think there are glimmers of hope there. If we can get some stable and long-term policy commitments and frameworks, then that gives us something to work with and develop sort of longer-term solutions. I think there's also the role for scientists and other experts to really set out what the pathways need to be, that we can then develop those products that can enable those solutions to come to fruition, including the things that are just starting out, as Pavan mentioned, that need that finance to get it going. And I think also the other part of the team is the demand from our customers and clients. They are becoming massively more climate and ecologically literate. Definitely at Ecology Building Society, our members are like that, and I think that's a change that's happening in society generally. Just we're faced with evidence of the climate breaking down and the ecological calamity that we're in, and I think that's really driving an appetite from customers to find a greener solution and a greener product. And there's also a massive technological pull that's happening. So, great innovation that we can really get lined up with. So I think the way we scale up and the way we develop products is really about working within that team. It's a really exciting time to be in finance. I'm a scientist by background, but I can so see how science is so important to connect up with finance to make it happen. But I think really it's about the financial institutions having that purpose, putting the just and fair transition at the heart of their business strategy. If we do that, we'll be climate resilient as well. It's win-win. And so I think the time is to be innovative and to be ambitious and show leadership as part of a team. So collaboration is definitely the way to go. So back to you, Philippa. Thanks.
Thanks, Alison. So I suppose how, amidst everything else that we have to do and all of the challenges that particularly banks and insurers are faced with at the moment, how do they know when they're doing enough? Just a question to the panel. Sarah?
I'm happy to have a go at that one, Philippa. It is, of course, the $64 million question. What we need to do is know that all of the assets on banks' balance sheets all have a path that is consistent with net zero. That is how we know we're doing enough. But I think that is easy to say and really hard to achieve in practice. And so what we need to do is start building our methodologies, our data, trying to understand what are the pathways that get us from where we are now to net zero. They will differ by industries, and work with customers to ensure that they are on that pathway to net zero. I think that requires risk and reporting, as we talked about, but it also needs, as other panelists have mentioned, sectoral pathways. What does change look like to get 30 million homes retrofitted with kind of new forms of heating and on a path to net zero? What does it mean in the hard to abate cement industry? We need to have finance and the real economy, the public sector and the private sector work together to work out how do we manage this systemic risk through systemic change, and try and do our best to understand that everybody has got a pathway to net zero.
And so again, that collaboration point really coming through of everyone needing to be in this together, as it were. Alison?
Just picking up on that as well, Philippa, I think that the way that we know that we're maybe doing enough is to be completely transparent and let our customers actually hold us to account. They're the best yardstick to know if you're doing enough, because if you're not, they'll let you know. Certainly they do at Ecology. So we have a structure that enables us to be held to account. So I think it's about being really transparent about your positive impacts and your negative impacts, and clearly setting targets as well. As Michael's mentioned, there are some tools out there that can help you set targets, and we can track our progress towards those. And again, that's about transparency and open reporting. And there are also fantastic frameworks that we can commit to, such as the principles of responsible banking, that you can really, if you sign those, then you're definitely signing up to transparency, setting targets, and holding yourself to account. So, yeah, keep us in the right direction.
Thank you. So I suppose if we can see the path, and we can see some of the challenges that lie ahead, this can potentially look quite scary for customers or investors or just other stakeholders. What do you think the role of the industry is in trying to, I suppose, mitigate some of that fear that will inevitably come alongside an honest look at what the future will look like and how they might be impacted, whether that's in terms of availability, price, different structures?
I'll jump in again if that's okay, Philippa. I think we do have to have a very open and honest conversation about what it takes, because as Pavan said at the start, this business as usual is not going to cut it anymore. So, but we just have to put the kind of the fair and just elements as part of this transition, that it's not just about environmental improvements and economic efficiency, it's about it being socially fair as well. So I do think that we need to have the right targets and the right measures, but we also need a very open and honest conversation that this is going to be tricky and it's going to be challenging, but we can do it. The solutions are there.
Yep.
What do you think, Pavan?
No, very true. And I think the need for all sectors to pull together, that was mentioned by Mike as well. It's not just about finance; it's by industry itself, consumers, and policymakers especially. And I think the need to change the football field on which business plays, that's absolutely paramount, because we just cannot continue with the same overall superstructure which we have within the financial system. Today, the fact that financial accounting recognizes contingent liabilities based on legal claims, that's good, that's nice. It forces you to have transparency on directors' bonuses, that's good, that's nice. But those legal claims are in the sort of tens to hundreds of millions of dollars, and the bonuses are in the single-digit millions or tens of millions of dollars. But when you have externalities which are in the billions of dollars or hundreds of millions of dollars, there's no requirement for disclosure. You know, the idea that we are in an age of transparency and that impact transparency is here to stay, that seems to be belied by the way that our financial accounting standards are simply ignoring impact reporting. So I think we need to move very quickly in the direction that the IIRC and the Capitals Coalition and the SASB are indicating, that look, we need to start measuring corporate performance in a holistic way. And I think that's very much part of the undercurrent, the dialogue that needs to happen and the transformation that's required. We can't measure performance only in terms of shareholder capital. It's got to be measured in terms of stakeholder capital, which means include impacts on human, social, natural capital, as well as produced capital. Otherwise, where's the stakeholder? The stakeholder typically is holding one of those other capitals.
Thank you, Pavan. So sorry, Michael, go ahead.
I was going to make a very brief comment, if I may, in response to the question about how do you make this less scary for consumers or people that for savers, for example. it's difficult, but the price that people pay or will have to pay, or their slice of the impact of GDP that is needed to solve the climate crisis, needs to be weighed against the counterfactual. What happens if we do not do that? But at the same time, we need to make sure that both of those scenarios they have behind them academic rigor, which is tough to do at the moment, because the price that it's going to cost to solve the climate crisis versus what would happen if we didn't do it rest on so many assumptions and rely on so many data sets which have their own issues. So it's a real challenge. And then it's really for the policymakers to say, well, who pays for this and in what proportion? And you could draw an analogy with COVID and the response to COVID. We have pulled together reasonably well to preserve certain participants in the financial system as a result of COVID. But who's going to pay for that? There are some decisions that have been taken, like, well, we'll freeze banking dividends in the UK, or we will pressure people to be less excessive with remuneration, at least in the 2020 proxy season. But then has enough intelligent design been built into that? Because by not paying dividends, you aren't just affecting faceless wealthy shareholders, you're also affecting pension fund holders, such as my beneficiaries. So we need to make sure that there is sort of second order thinking in who pays for this, and that it's weighed against the counterfactual of not paying for it at all.
Thank you, Michael. So if we move to some questions from the audience, and if you do have a question that you'd like to ask, then please do so. So we'd be interested in each of your views on this question. What financial products do you think have the potential to make the biggest change? And I'll go to Alison first, perhaps reflecting on some real life experience of your own portfolios as well as in theory.
Yeah, thanks, Philippa. Yeah, so for us, we in our experience, we have tried to create financial products that create or encourage the right behaviours. So at a very simple level, we pioneered, and lots of people are doing it now, which is fantastic, because that's what we want to do. We want to create change. We pioneered a set of what we call sea change discounts, which is where we actually reduced the interest rate on the mortgage in line with the more energy efficiency, the greater the energy efficiency of the property. So it kind of incentivizes you to make improvements to the property, because you're then paying a lower interest rate, and that's been really well received by our borrowers. Indeed, we won an award last year at Finance for the Future for this. So I think products which can encourage the right behaviours and reward those behaviours are going to be really good. I also think that when we're talking about carbon, then we need to not just focus on the carbon that's created within the operational carbon, but the embodied carbon that went into any materials and the construction and so on. So there's an opportunity to look at the sort of wider impacts that we're also thinking about building into our products going forward. And also, I think products that look across the supply chain and try and build partnerships in that collaborative approach that Michael talked about, that we can try and work with the new and emerging areas that have got great promise and try and bring them on. So yeah, lots of opportunities.
Could I jump in from an institutional investor perspective? I break the question down into old capital and new capital. And I think with new capital, there are some wonderful financial products for investors to think about in terms of green bonds of a sovereign or a corporate variety. And infrastructure would be the other asset class that I would pick for making real world change. And a whole bunch of investors have jumped onto that. I still think there's room to grow. Some people would argue that that would lead to a green bubble. But if you look at the Climate Change Committee's report today, for example, it suggests actually, well, there's still some white space here. I think in terms of old capital, we have to be quite careful. And by old capital, I mean trading in secondary markets, listed equities, for example.
Can I come in, Philippa?
Yes,
Getting
please
the
do.
companies we currently invest in to improve.
Oh, sorry, Michael, please.
Oh, I don't know if my internet cut out, but I was going to just make the point that in secondary markets, to create real world change, it's about engagement, it's about using your shareholder rights. I don't think it's about investor A selling his or her shares to investor B, and there's no actual real world change.
Yeah.
That
Sarah.
was exactly the point I was going to make. What we need to do is manage the risk at the level of the system. That requires stewardship so that carbon is not emitted. It is not about divestment. Divestment means I don't own the carbon emitted. It doesn't mean the carbon is not emitted. So if what we're about is managing the risk at the level of the system, what we need is transition finance that enables those that are currently emitters of carbon to be on a pathway to net zero. I think the other important point is to think about blended finance. That's because this is a global problem that requires global solutions. Much of the need for finance is in the developing world, and putting the power of the public sector finance and private sector finance is going to be key if we're to make sure that there is a new world built in the developing world that is consistent with our carbon budget.
Yeah.
Pavan?
Yeah, you talked about products, but I'd like to quote a product which is not from the private sector or from the world of financial innovation, but actually from the public sector and from the finance ministries, and it's called taxation. Today, all finance ministries, I'm sorry, this is including Her Majesty's government, all finance ministries in the G20 are fixated on a model which I broadly describe as taxing the goods and not taxing the bad. So, corporate innovation and enterprise, corporation tax, hard work salaries, income tax. But when it comes to GHG emissions or mining, resource tax, no, you don't want to go there. No. And there are countries like Australia where there's even concept of finders keepers. So you can extract and mine gold, but you can't pay tax on that. So we need to rethink this. And the reason why we must rethink this is because it's giving the wrong incentives into the system. Honestly, we need to worry about the nature of taxation and frame it not just because it's creating environmental disaster, but because it is not sustainable from a finance ministry point of view. If you think about income tax and corporation tax, where is the political appetite for increasing taxation rates or for increasing the pie at a time when economies are suffering, profits are suffering, competition is increasing, capacity is increasing, there's still overcapacities? Where's the question of higher profits, or for that matter, higher incomes in a world in which employment is shrinking? So the size of the pie is going to shrink, and we better get used to that. So that mindset of the finance ministry that it's all about income taxation and profits taxation has to change, because it's not about that anymore. We need to think of other ways of raising financing. Otherwise, you will basically have unbalanced budgets for decades to come. So I think there's a fiscal reason for this as well, in addition to an environmental reason. We need to change this model towards taxing the bads, disincentivizing those, and taxing the goods less. I mean, you can't flip from one to the other. What you can do is increase one side a bit, decrease the other side, but that needs to be done.
Thank you. So I suppose with that shrinking pie that you referred to in mind, going to another question from the audience, how important is it that climate change is prioritised in the economic recovery after COVID-19?
Why don't I start on that? It's absolutely essential that climate change is prioritised as we build the recovery. As I said in my remarks, the actions that we take in the next decade, the next 3 to 5 years, are going to determine the future risks that we're going to face, and therefore the size of the economic pie that there is on the table. There is no choice. We have to make sure that we use this opportunity to build back better. And to some of the points that you made at the start, Philippa, I think kind of with the UK hosting COP at the end of next year, with the change in administration in the US, my sense is that there's real appetite for there to be such a change. So I'm positive about that, but I really don't think we have a choice.
If I could,
Go ahead, Michael.
if I may, just quickly, thank you. I've had a few of these questions on panels recently about how does COVID change things, or do we need to accelerate as a result of COVID, or does COVID increase the S in ESG? Those kind of questions, and my answer usually is that, well, we were believers before COVID, we're believers after COVID. Climate crisis was around before COVID, it will be around after it. It doesn't change it in that sense. But I think that in response to this particular question, there is a COVID nuance. And perhaps this is one way of bringing it out. We have very little room to go on a monetary policy, from a monetary policy perspective, to maintain financial stability. So it might be that more and more economies have a greater fiscal expansion in order to maintain and boost the recovery. And if we have a Keynesian in the Fed in Janet Yellen and a Biden administration, then perhaps we have the pieces in place to make sure that it is a green fiscal expansion, and that we don't have jobs for the sake of jobs at the cost of the climate. That said, I think one of the biggest underappreciated risks in the climate transition is the social element or angle of climate risk, where we see risk crystallizing, such as with the Gilets jaunes in France. We need to tackle both. So I think that given the policy making response to COVID, it does actually shed a new light on from a climate perspective.
Thank you.
Philippa, can I just jump in on one point? I think it's basically like we've got no time to waste on climate change. We have to do something now. So you might as well do it now. I mean, really what we do in the next few years is going to define our future. We can't wait to 2030. We've got to get on and reduce emissions by, over half by 2030. A great report from the Committee on Climate Change today set out a fantastic pathway of how we can reduce emissions by 2032, very granular detail, and that is what is required if we're going to stay on the 1.5 degree pathway, and the alternative doesn't bear thinking about, really. So I just think we don't have time. That the budget that's left before we kind of surpass that tipping point and we go past 1.5 degrees is really small. So if we continue at the current rate, I think we use that up within much less than 10 years. So we have to crack on and do it now. No time to waste.
Yeah.
Thank you. Pavan, any views from your side?
I think I very much agree with what the other panelists are saying, so nothing to add right now, but absolutely agree with these thoughts. This is the time. If we don't act now, then I think generations going forward will hold us to account.
And is that the way that we make it real for people who perhaps aren't as far along in their climate journey?
Commitment,
Is it those investors, those customers, when will they start to see this crystallize, and how do we bring everyone on?
I think it's already happening. I mean, speaking from wearing a WWF hat for a moment, we're seeing an increase in commitment and donations and questions and engagement from people, which has been driven by COVID and driven by the Australian fires and driven by some of the storms and cyclones, floods and droughts that have affected. So I think we're touching a nerve of human awareness, a transition in human awareness, and we must try and capture that. As I think it was Martin Luther King who said that there's a tide in the affairs of men which, taken at the flood, leads on to fortune. It's that kind of time I think we are living through. So all of us really must say, look, be more vocal, be more out there, asking for change, insisting on change, participating in change, and delivering those innovations and policies that are required to take this economy towards one which is genuinely a green and equitable economy of permanence, one which generates higher levels of fairness and environmental stability.
Philippa, if I
Sarah?
might add to that, I think the theme of collaboration comes through. Then we can lead the way, we can show the way. Ecology Building Society can take its products and its targets, be very transparent about them, and people can learn from them. We've set up a climate financial risk forum that's designed to do exactly that, to get the best practice on how to do this, put together in one place and disseminated so that everybody can learn from it. So my 3 themes are: act now, collaborate, be brave, and show leadership. And I think we can do that.
Thank you. So I suppose on that theme of being brave, and further question we've had through, what needs to happen to have the voice from the top of the asset managers change the approach of fund managers, for example, at BlackRock and others? So I suppose without getting into any specific firms for the purpose of this conversation, are we seeing that change at the top? It feels like we are in some areas, but the question might suggest that maybe we aren't.
Well, there is, if I may take a stab at that. I mean, there is a problem and an opportunity. With the problem being that most financial assets are benchmarked against indices, and most indices are kind of ethically challenged in terms of not excluding what should be excluded. But on the flip side, it's really just a choice of the asset managers promoting to the asset owners that, look, there's an alternative. I mean, if you look at MSCI's vast swathe of indices, they have numerous indices which are cleansed of some of the negative sort of areas, be it tobacco or be it fossil fuel. So it's a choice, and we can make these choices. It's not that difficult. It does, again, need the salespeople within these teams to go back to the asset owners and say, look, and by the way, you can make a different choice now. Inform people that choices are available, and we don't have to stay with the old hierarchy by any means.
Thank you. So we talked about data before and some of the challenges around data. Question from the audience: how can smaller institutions ensure that they have the right data to play their part? So I suppose we know there are data challenges, whether it's obtaining data, systems. Alison?
As a small financial institution, maybe I can put my own take on that, as we're in the throes of collecting as much data as possible. And again, I think it comes back to collaborate, because you can obtain an awful lot of information by collaborating with others. So, for example, at the moment we know that we are supporting energy efficiency in buildings. And we have a very simple measure of that, just using the energy performance certificate, but we're wanting to translate it actually into carbon emissions resulting from the property, both the operational emissions, and in time we're moving to the embodied emissions that came from actually making the property or renovating it. So we're collaborating with the Partnership for Carbon Accounting Financials, which has got a UK chapter. So other organisations who are looking at this webinar might be interested in looking at PCAF and their work plan, because that is all about collaborating and enabling us to get the tools to get the data. So we're not alone. We're all in this together of actually trying to get our hands on that data so that we can be as informed as possible. I think the thing that's more difficult is the kind of social impact side. Again, that's about reaching into your stakeholders and actually having that dialogue to get that information.
Thank you. So what I'd like to do now is go back to that poll question that we asked at the beginning and see if the sentiment amongst the audience has changed at all. So are they more confident after hearing from the panelists, or have we taken to heart that potentially scary transition and are feeling less confident? So the poll should be on your screen now. So how confident are you that the finance sector will show leadership by driving a more sustainable economy? Very confident, confident, either confident, unconfident, or not confident at all, or don't know. And I think based on what the panelists have spoken about today, and that leadership will really be a collaborative effort, and needs to be a collaborative effort to make that work. So we'll just give you a few more seconds to vote, and then we should see the results coming up on the screen in a moment. Okay, so we've got a bit of movement there from confident to very confident. So previously, very confident was 11%. Now, after hearing what you've had to say today, 27% of our audience are very confident, which is great.
That's amazing.
So I think we can say job well done in that sense. So thank you very much, everybody.
Thank you.
So that's good to see that movement there. That's really helpful.
Philippa, what would you have said if it had gone the other way?
Please, no.
I would have said we've clearly realised the gravity of the situation and the need to act now. We've got the positive message, so that's good.
Well, we've got a good message, so that's
Yes.
very good to see that.
Brilliant news.
So what I would like to do now is just share a short video with you before we come to the conclusion of the session. Shows you just a little bit more about Finance for the Future, and all that remains for me to do is just to say a huge thank you to our panelists. So thank you, Pavan, Alison, Sarah, Michael. As we saw from the polls, that was obviously a very convincing discussion, lots of information, lots for people to think about. So thank you very much. And thank you to all of our attendees today. We hope you found that useful. And if you do want to know more, financeforthefuture.org is a good place to start. And thank you very much for attending.
Thank you.